Chapter 1, Insights from Mr. Ramesh Damani. We are in this new book series, learning from each of the super investors in India, Masterclass with Super Investors by Vishal Mittal, Saurabh Basrar. Excellent book. Like we learned from Richer, Wiser, Happier from William Green, we learned about super investors in the United States. Now we're going to learn about super investors in India. And Ramesh Damani, the interesting thing about him that I learned was he's a computer guy. He's a technology systems programmer. And he worked as an analyst, stock systems analyst, right, in the United States. Got his MBA from California State University in Northridge in Los Angeles area, very close to Hollywood. So he has this edge of technology. He understands tech, which is huge. And so he was quite stable, happy working in the United States. His father had a deep background in investments in stock market. Like this is like the 1960s, right? Very early. So his father had a background and was investor when no one was investing, right? Like very early days when the Sensex was like 100 or maybe lower, right? And so even when he had a stable job, he left and came back to India and built a brokerage firm first. He had a green card, but his father convinced him, and so he did back and forth. So his wife and son actually lived here for some time, and then they went back and forth. So a very interesting story of how he pivoted his career from a technology software guy into an investor, like a super investor. So as I said, his edge was in technology, and his biggest bet was the Infosys IPO, right? Like he bet big money in Infosys. So he made a lot of money in Infosys. And his biggest mantra is you double money every 3 years after having like, let's say 10, 20 lakhs of savings. And then you'll be super rich in 30 years because you'll double 10 times, right? So that is huge because of the power of compounding, which he understood very early. His father gave him a $10,000. Back then it was $8. $1 equals 8 or 9 rupees. And he lost pretty much all of it in the US. Remember, it hurt his ego quite a bit because he had an MBA. So pretty interesting story that's in chapter 1 about him and how he started his investments. And he learned that you shouldn't be investing looking at the rearview mirror, but instead looking at the windshield, looking forward for the future. And he came up with a lot of really good bets, which are like 100 baggers for him, made him a lot of money. So 10 doubles, right, every 3 years makes 10 lakh rupees into 102 crores, which is massive. If you invest 30 lakh rupees from 1993 to right now, you would have 300 crores, which is massive. But doubling every 3 years equals 24% compounded annual returns. So 72 divided by 3, right, approximately. So the rule of 72, yeah. So his key insight that I found was he used his core competency, which was technology, to bet big on companies like Infosys. He understood the arbitrage there, and he bet big money. How he was able to bet big money? Because of the conviction that he had, because of he was investing in his area that he understood. So you build large bets once you have conviction. And he says backing up your truck or bet the bank. These are the two terms that he uses quite often, which is like, and he feels quite sad. Even though he's made a lot of money, I feel reading the chapter that, hey, he could have done better. He could have done better. Sure. But you've already done so well. So it's okay. Relax, So he says when you have a great idea, back the truck and buy with large stake, because people can say, hey, I bought a stock, it went up 6x, but then you ask them what percentage of your holding or how large was your investment. So, it's just 1%. Doesn't really matter, right? So he's right. So big conviction. So having a vision of the future as to you think that this company Infosys will become big, or this company with a small market cap can be this much in enterprise value over 10, 20 years, because you can he even compared like companies in India to companies in the United States for the companies that he bought, and he clearly saw that there's a huge opportunity. Then he built that conviction to buy large stake, and then he had a patient holding period time, which made him a lot of money. So that's his core formula: vision of the future, big conviction to buy large stakes in your core competency, and then the patience to hold and not cut your winners. Like he even said that he had Infosys at some point in his portfolio, which had 90% of Infosys was 90% of his portfolio, right? And he says, don't buy stocks which you will be scared of buying after they've corrected 50%. Great rule of thumb, right? So really good rule of thumbs that you get, meaning don't speculate, don't buy for price action, right? And don't cut your winners like he let Infosys run. And measure yourself on how much you could have done versus how much you did actually. Great. But I think he's still wishing to do more and better, which is, I think, a good thing. Evaluate the company's market cap in the future as a good way of building a bet, right? Like the closest thing that came to my mind was Info Edge in India. Close to, even today, it's valued at 6,000 odd rupees per share. It's valued at $11 billion. And LinkedIn was sold to Microsoft 5 years ago to $22 billion, right? So that's an insight to have, like, hey, look, there's this company, InfoEdge, which owns Naukri.com, has a large stake in Zomato and so many other companies. That could be a big winner. So when you understand the domain or the company that you're in, so I worked at LinkedIn, so I understand that. And so then I can try to understand like what Naukri would do for India and similar place in India. So InfoEdge came to my mind as the biggest learning from this chapter, which is slightly closer to my area of competency, right? Or my understanding of the company. And so he also shared this other thesis of Quick Heal Technologies, which was a recent IPO, and his buy price is available today. So it solves for security in the public market. It's the only big play in security, Quick Heal Technologies. So he thinks that the cyber warfare is going to be the big one, and people would need help to be secure. So he's bought big into that. And one other key learning from him was you can't piggyback on someone else's idea and someone else's conviction, which is easy once you read it, right? Once you read that line, you're like, yeah, it doesn't make sense. But if you are convinced because you've done some homework, you've read a few annual reports, you have actually built your conviction and have an independent thought as to why this company will do well, then you will hold and you will stay put. So building your conviction is important because then you will stay put. You will actually stay invested, because that's the key. People invest and then they leave, invest and then they leave, and then they miss most of the upside. So building independent thought, building that conviction, building that large portfolio with things that you understand was a really good insight, because that'll make you stay, that'll make you invest, and that's needed for you to compound wealth in the long run. So again, back the truck, bet the bank. He learned that courage and conviction from Rakesh Junjunwala. It feels like reading the book. Doubling 3 years, 24% CAGR. He says then you're doing great. Shared really good resources. financialtimes.com, wallstreetjournal.com, thebrowser.com, longform.org, which helps read. So his biggest insight is that reading broadly and reading widely helps you connect the dots. You will put in a lot of information, but then they'll help you make the right decision. So reading is his biggest pet peeve. He likes to read. Like he himself says that he's the Charlie Munger of India, because Charlie Munger, people tell that he's a book with two legs. So he said, I am that in India, right? So he's a self-proclaimed Charlie Munger, which is pretty cool, right? Like he likes to read. That's all he's saying with that, right? And he likes to read. He does deep investment research. So some of his large bets paid off. That made a lot of money. And he's quite active on YouTube with some of the videos that come out. He's regularly speaking at Motilal Oswal, Flame University, and you learn a lot from him. So quite giving back to the community. Very good in terms of giving back. And he shared an insight about small caps and mid caps, which is what his core area of competency is. He looks for companies less than 5,000 crore market cap, and then he thinks about like where would that go, what would be the 10 years look like, and then he bets big, right? But he makes a lot of judgment and judges those founders in terms of how they talk, the level of conviction, where their focus is, their body language, and that judgment helps him understand whether he should be investing large sum of money in them. He looks for skin in the game, and then whether they talk, the way they talk is credible. So a lot of really insights that you can learn from him if you want to get good at buying these companies. You need to do those visits, because otherwise what the founders say versus what the reality is could be very different. That's his key insight too. And he also says he's really good at detecting the bull market end and the bear markets, end, and then bull market starts and bull market tops, right? Which I think is impossible, but he still says that he's gotten a good knack of it, and he says that he's getting better and better. I feel that was a little bit of an over exaggeration, like no one can actually say when it's done, but he shares some really good insights. Like he's seen like at the end of the bull market, when it's going to get over, you see sharp gains. Like Infosys was an example where he shared it went from 10,000 to like 14,000 in like 3 days, like 40%, right? So when that happens, he knows he needs to get out, and that's what he did. So he's actually good at it. Doubtful, possible, right? So that's a good one. And so he can detect extreme valuation. He can also detect when there's a common talk or sentiment that everyone has the same set of shares in their portfolio, then that's the end of the bull market. And the way he exits is that he shares, he sells every week 10%, 15%. So he's out by like 6 weeks, he's done, right? So he doesn't really time saying, oh, I'm going to be out today. He just times it over weeks, which is a good one. Like if you for somehow become so good at timing, then you can actually use this, right? But he still cautions at the end saying, hey, time in the market is better than time in the market, right? So it's just good. So he covered it up a little bit, but like whatever he says here, I think it's an overstatement, right? Where he can get really good at detecting this bull and bear markets, right? Shared about 14 years of bear market in 1968 to 1982. It's the longest bear market. Similarly, we are in the largest and the longest bull phase from 2008 onwards. Shares that speculation has a huge toll, so investing for price action is very expensive, and he doesn't want to do that. Needs advanced knowledge to do F&O, futures and option, and he stays away from it. He says leverage can wipe you out, and that's true for most people, so he advises against leverage. Deep knowledge of psychology, price movement, street smartness is needed for F&O, and so he just stays away. Remember, he also shared in his chapter that he did that in the US, I believe, and he failed miserably. So he's just comfortable to say, I don't do this, right? And so the last takeaway is, he says, his formula for success for most people, which I really resonated well with me, and I think what he says was save extremely well, meaning be very frugal in the first few years, build up a capital of 10-20 lakhs or something that's reasonable, and then double every 3 years, and then double 10 times, right? Which is huge. So saving, I think that's possible, but that's still difficult, but possible. And then if you double every 3 years, that's huge, which I totally agree with, right? But doubling every 3 years is like 24% compounded rate of return. There'll be very few people who could do that consistently for 30 years, right? So that's the key. How do you build a vision for what is going to double every 3 years? which is a good management, which you buy not for extreme valuation, and you agree that the market is fair in the long run, which is it's a weighing machine, not a casino gambling machine, right? Which is true. So identifying, staying, betting big are the key learnings from Ramesh Damani. Lot of insights. I could relate a lot with him, with what he's done and how he's investing and some of his thesis. The only thing that I would caution the reader for this chapter is timing the market's very tough, so stay away from it. Meaning, make sure you have enough cash balance to handle the bear market scenario. Don't time the market consistently, just go invest, right, in a systematic way. Very hard to time the market for most people. Thanks.